Rick, what's going to happen in the next few months? We've got supposedly something big happening at the end of this month. And then what's happening sort of 6 months, 12 months out? Are we going into recession, and what's going to happen with property?
And that's the golden question, isn't it? Are we going into recession? I think, if we could answer that, then you and I would be doing a better job in the government than most people we've got at the moment. But we're not going to keep this as a political post. So what do I think? Well, the predictions it depends which article you read. And I think it's very subjective. The predictions are at the moment that if we leave on the 31st of October without a deal, then we're going to see a correction in the property market. And that correction is going to be, according to all of the articles that you read, anything from 10% to 30%. Now, the Bank of England think we're going to see a 30% reduction in property prices in the first 12 months, and with another correction coming back into the end of 2020, which will bring us back to the beginning of 2019. But if you read articles from Rightmove and Zoopla, they are saying about 15 to 19%. Now, it depends on where you are in the country, because at the moment, if you invest in the north, properties in the north at the moment are achieving 100% of asking in certain areas of the north, northwest specifically. Scotland, folks, if you're in Scotland right now, Scotland market is just taking right off. So we've seen about 7-8% increase.
Do you think it's sort of playing catch up? It's sort of back of the roller coaster.
They're not really affected by Eastern European Eastern European issues as much as potentially we are in the
Immigration.
south. Absolutely. Yeah. So property market around the north at the moment is going really well. So places like Warrington, Chester, Manchester, all of those places are achieving maybe a little bit more than asking. So if you own property and you're looking to sell now, it's a great time to sell in the north. In the south, we're seeing a big decrease at the moment. So year on year, London and areas of London are seeing a decrease of about 0.8% at the moment, year on year. What remains to be seen all really depends on what happens on the 31st of October.
So, okay, so that's sort of what's likely to happen, if we have a no deal, potentially, but no one really knows. But does that mean we just sort of sit on our hands, stop? What do we do? What action do we take?
It's a great question. And, when we first started to hear about Brexit, what was it? I don't know, three and a half years ago, people were saying, right, that's it. I'm not going to do anything because we're too volatile right now. The economy could do anything. Nobody knows. And I was about to buy a deal. And this deal was on the market for 1.3 million. It's a block of flats. And negotiated it down to 1.1 using our ninja negotiation skills. And everybody was saying, don't do it. Don't do it because, potentially this could be the end of what you do. And if the market falls flat, you're going to be negative equity from day one. Now, we bought this with traditional means. We just bought it with normal lending, 25% loan to value.
For 1.1?
For 1.1 million.
Yep.
So we were in for just under $500,000 in deposits. So we did. We bought it. And despite what everybody else said, we carried on, we developed it, we got planning permission, and we had that property revalued about 2 months ago for 2.2 million. We've got all of our money back out and some, and obviously we're still only like 75% loan to value. And I think the moral of the story is there's always going to be something, Mark. There's always going to be something that stops people from investing. There's always going to be somebody that says it's not a right time. And again, if we go back to the late 80s, early 90s, when we had Bradford and Bingley and Mortgage Express, and the people that were all of a sudden same-day refinancing stopped because it was regulated. So for those that are watching, going back to the early 90s, some of the large landlords now, they have got their portfolios by doing leaflet campaigns and getting what we called then same-day refinancing. So they buy the property below market value, they would then go to the Mortgage Express, who would buy it off them at market value, so they were getting paid for buying houses.
We did a few of those back in the day.
And that was the big one. That was, leaflets and the
no money down, cash back.
That, absolutely, cash back mortgages. Yeah. But when that stopped and all of the sale and rent back and all of that started to become regulated, everyone was saying, it's over.
All done.
It's done.
We're all dead.
That's it. The private rental sector now is over. And I don't think that's ever going to change.
No.
So,
They moved into something else, didn't they?
You've got to survive.
They sort of went into service accommodation, lease options, all that sort of thing.
You've got to adapt to survive, right?
Yeah.
And we look at all the big companies and the big players. the ones that haven't adapted, I mean, Kodak, for example,
Yeah.
they didn't think that the digital market was ever going to do anything.
Yeah.
And of course, they'd just get wiped out.
Ruined Richmond, didn't it? All that, and
Absolutely.
You know, if they'd gone into, I don't know, digital cameras, well, they suppose they did, but they were. I bought one; they were rubbish, weren't they?
Yeah. So that's my thoughts, you know, and I think you can't just focus on the stuff you can't control.
No.
Because things that, you know, shit's always going to happen, but you've got to be able to adapt to survive. And that's what we do, and that's what we do in any industry, not just property. I mean, what do you think? I mean, you know, is that a fair assumption?
I think that people absolutely will adapt, and you know, do I think necessarily that prices are going down? No, I don't necessarily buy into it, because you know, obviously the Bank of England have made an assumption if X, Y, and Z happens, and it's not even a prediction; it's just one outcome.
Yeah.
And there are several hundreds, if not thousands, of other outcomes depending on what happens at the end of October. I think that you know, there's a reasonable chance that, you know, what is no deal anyway? You know, is there some halfway house? Do they do some sort of, I don't know, cobbled together agreement on WTO terms the next morning? Who knows? You know, and it may be an opportunity the next month to get stuff very, very cheap because people are thinking that. So, you know, it's probably always a good time to buy, but at what level and at what yield? And I think if, you know, you're focusing on long-term rental and holding, I know you are, you're very focused on yield and income. And the capital value, well, yes, we all want to know, clearly, you were much better off buying that unit at 1.3 instead of 2.2. You know, wow, what a deal you did. You know, but lots of people, including the ones you spoke to, would have said don't do anything, and you'd have missed out on £1.1 million in equity.
Absolutely.
So I think it's always a good time, but at a price level. So yes, and also it depends where you are, doesn't it? I mean, if you're, you know, for me, the cycle, the new cycle, it always starts, I think, London, maybe Mayfair. Yeah, so I think this last cycle probably started in 2010, post the last recession. Mayfair started going up, you've got Kensington, Chelsea, all those areas, and they went up gangbusters, like 2.5 times, something like that.
Crazy.
And the North didn't do a lot, Scotland not a lot. Peterborough got going, I don't know, maybe 2013, 14. You know, we were further down on the roller coaster, and the price rises then spread up the country, because clearly, you know, if one area's gone up and that area's cheaper, more people will move to that area until prices, you know, get back to equilibrium. So, you know, if there are going to be price falls, where are they going to be most accentuated? Well, you know, to be fair, you know, if you look at a lot of, you know, the sort of higher end areas of London, the areas that have, I don't know, maybe a lot of, you know, European, higher level type buyers that are maybe currency or EU, you know, dependent. You know, they're maybe using passporting or whatever. Maybe they're working in a bank, and therefore they're using the passporting rules to do business, sort of, you know, trans-European business. Those people have the numbers have, you know, reduced in terms of the numbers that are coming over, and lots have gone home. So those areas. The values have dropped, and
so do you
know,
think
less Russians.
Now's a great time to get into London?
It may be, because if you look at those areas, they've dropped 25-30%. If you're at the coalface looking at it, I can see all sorts of examples.
Lots of investors that are struggling to sell right now.
Absolutely, and the stamp duty ruined it above 1.5 million. So, you know, how further is that really going to fall?
And it's relative, Mark, isn't it? Because the way, I mean, I said earlier that if you're in the north, properties are achieving 100% of asking, but your yields are going to be so much higher because the property prices are so much lower anyway. I mean, you could get, you know, a mid-terrace house for £45,000 in streets in
Sunderland.
You know,
one of my mentees yesterday was talking about one.
But they're still achieving £450 to £500 a month in rent, so the yield is still going to be very high, but we're not going to get the capital growth. And as you said earlier, you know, we buy and we hold, and we buy for cash flow. So if we get growth, it's great. If it doesn't happen, not such of a worry to us. But that kind of affects the no money out strategy, because if your capital growth isn't going to go up, and unless if you've already bought a house on the street that's worth the same as it is next door, even if you put all of these singing and dancing en suite rooms in, it's not going to be worth that much more. So it's going to be attractive for armchair investors that are happy to get a good yield. But perhaps not so much for people that are looking to momentum invest. Yeah,
I mean, I suppose with that investment that you just mentioned, I don't know what type of property it was exactly, or specifically, but the surveyor potentially probably did an investment valuation on it, and therefore valued it on yield rather than on a comparable basis?
No, we actually got it valued on bricks and mortar because it was better for us at the plant. So we bought it, without going into too much of the details, but we bought it in split titles, because you can only do that on purchase, as you know, or sale.
Were they houses?
They were, it was an old school. So it's the whole street, it's an old school, converted back in the 1950s into individual HMOs. So it was a 28-bedroom HMO, listed, conservation area.
So were they split into fives or?
4. Split into 4 houses.
You told me about this one.
So it's the whole street. So what we did, we went in and we tried to make this deal stack as a HMO. We wouldn't have done. We'd have locked in quite a lot of money over a long period of time. So the only way that we could get our money back out on this was to decrease it from 28 HMO rooms into 25 30 square metre flats.
Yes.
And then, of course, 30 square metre, we can go for financing. We split the titles on each individual property when we bought it, and we got a load of land at the back which we split at the same time. So about 70k in on due diligence.
So you kept them all as freehold, you didn't issue leases?
No, so it's all individual titles still on the properties. We haven't split the individual flats, but we can do because now we're separate. So what we did was we turned them into 25 flats and then got them valued per block on a bricks and mortar valuation.
And if it's a flat, usually a surveyor will go, right, I'm going to do it on a comparable basis. What are other studio flats in this area selling for?
You got it.
That's what it's worth, and multiply it up.
Absolutely.
So that's one way, and then the other way.
The yield side of things where we are isn't that good,
isn't it?
It's probably about 9.5–10%. So it's not that good. So if we'd have gone through the yield basis, we wouldn't have got as much money back in.
That's interesting because around here, it's surveyor dependent. But if I bought something, I converted it, and then I got it revalued based on yield. It'd be similar. I'd probably get 9%, something like that. And that's probably still just advantageous. The point I was going to make, though, was it's quite interesting because coming into a period like this, we're talking about house prices maybe dropping. Yes, flats and houses valued on a comparable basis may drop that much, but what happens in terms of commercial buildings or hybrid sort of residential that are valued on a yield or investment basis, does the yield go up? Do we get, in the good times, do you get yield compression and therefore the capital value rises? It'll be quite interesting to watch that because for me, the value, the sort of yield, the standard sort of yield that they've been valuing on, obviously it moves around dependent on surveyor, has been pretty consistent, probably for the last, 8 years that I've been doing that. But
for us to get that kind of cash we got back out of that deal, we'd have needed 6.5, 7 yield, and we're never going to get that, So when people talk about commercial commercial valuations and what have you, and they get very confused with valuing yield and yield in terms of return on investment, and so for that deal for us worked out really, really well, really well. But you're right, in commercial buildings. I've always stayed away from commercial buildings because the way we operate is that all of our deals are money back out. They have to be, otherwise we're not interested.
I quite like that, really.
And it's with a commercial building, you're like, well, are we, aren't we?
To be honest, that you've just hit the nail on the head. I mean, that is my whole mentality. If I've got to go and leave 40% in something.
And how long do you leave it for? We looked at the offices we operate from. We don't own them, we rent them. We were going to buy them. And we looked at the comparable of the valuation now to what the guy paid for it 8–9 years ago, and it was the same. So if we're going to go in, we would have been 80 grand in.
It's a bit like these. We're sitting in an office building here. We paid £90 a foot. They probably went up to about £130 a foot, something like that, by 2013, 14, and they've gone nowhere since.
Absolutely, and that's case in point.
A lot of commercial buildings are like that.
I don't want to leave 80 grand in an office when we've got the flexibility now as we grow, we can move around and what have you. Although we're paying quite a lot, but you get what you pay for.
Yeah, just I suppose the good thing about buying if you're going to be an owner-occupier, obviously you get your capital allowances, and then for us, this building we're sitting in, I think it's 5,350 square foot.
Is that with the two?
No, we've got 11,000 square foot we've got three. There are two semis there that we knocked together, and then this is a detached office building which we use as offices. So it's about 11,000 square foot. But this building, the rent would be, and the rent we pay ourselves is about 57,000 a year, something like that. Mortgage 3% on, I don't know, let's say 500,000, something like that. You can see it's 15 grand. It's not a lot, so there's a massive difference. So that's how we're making this pay, because yields on these are usually 10% gross. So I think if you're going to move into it and it's long term, you're going to be there long term, I think it can be a great thing. And
it's affordability or the selling factor in the future as well. So
what's
the exit? How attractive is somebody else's office to somebody else? You know, by the time you've put all of your stuff in, and you know, unless you lease it out to them and put a dilapidations clause in. But that's why we don't do commercial.
It's funny, you know, because there must be some models, Rick. This sort of leads. There's a bit of politics here, but
no politics in the room, folks, right?
But it's important because it's related to what we're doing. I have this thought in my head quite a lot in terms of Rob and my portfolio. When we get to the end of this sort of current developmental cycle, you know, how much more residential do we want to buy? And it's sort of,
how much is enough?
How much is enough, and how much residential is enough? Because of course, my attitude 10 years ago would have been, well, it doesn't matter, just keep going, it's never enough. But with what they've done in terms of, I don't know, Clause 24, you know, getting rid of the Section 21.
Do you still have properties in your own name?
Well, we've moved the majority out into limited companies, so haven't got that issue. But it's less about that because it's dealt with. It's more about the direction of travel in terms of the sort of political backdrop. You know, they're trying to ban the Section 21. They're, you know, Corbyn's there saying, oh, rent control and let's let the tenants buy and all this. And of course, you know, thankfully, there's a good chance he won't get into power, and thankfully, quite a lot of what he's proposing, A, probably isn't workable, and B, can he get it through the Commons, and will his MPs go for it? Who knows? But it's a risk. And my attitude to all this is, you know, do I want to stop doing property? No, I want to carry on doing it until I die. If I'm really honest, I'm going to get bored but maybe the thing to do is to sort of hedge. And, you know, maybe finding some sort of commercial strategy that is good, where you can strip the cash back.
Do you think there's still place for commercial on the high street, though, Mark? You know
well,
what I mean,
that's retail, isn't it?
Well,
it doesn't have to be retail.
You know, talking about thinking outside of the residential aspect. I know that there are people out there that will go and source property, but only if they've got a blue chip ready to go into it.
I mean, that sort of thing I love. I've done a couple like that where I've put really good, you know, tenants in, 500 million on the balance sheet. They're both, one's retail, one's sort of more, I don't know, financial services.
And did you put the tenants in, or were they in situ?
Yeah, so one was sort of sourced by an agent, and then the deal but then I bought the building and brought it all together. And then the other one, I found the tenant completely under my own steam. And then I've got another one I've lined up. Again, the company's worth 500 million, huge balance sheet, so it gives a good uplift.
I know who that company is.
Yeah. So clearly it gives you a good uplift, and that's a sort of retail environment. So you can, if you do that, you clearly can strip your capital back because you know you've created a great. But of course, I've had to buy those buildings, take a bit of a risk, and then get them in afterwards. Clearly, the Holy Grail is lining it all up before you committed, and I haven't seen many people manage to do that. So I think that's one sort of road to go down. Would you want loads of retail, you know, with Amazon and, you know, is it kind of, you know, I'm not...
We've got garages. We've got like 14 garages in the city centre, you know, dead cheap.
You let them, do you?
We do let them. for virtually nothing, but I'm land banking with those. Yeah. It's in the city centre.
So it's going to be a development.
You know, eventually we're going to probably be able to do something. And we've got pubs and we've got holiday lets and we're quite diverse with what we've got. You know what I'm really interested in right now, as well as HMOs, is the holiday let market.
Well, you know, serviced accommodation's been a huge thing, isn't it? And of course, it does sidestep a lot of these rules. There are probably other risks. Maybe there's a planning risk, you know, in the future. But the point is, all these risks are not going to crystallise together in different sort of different property styles. You know, maybe commercial, residential with a long-term tenant, or maybe serviced accommodation. Something's going to happen, but it's not going to affect them all together, and you're going to be able to. So I think it's a good idea to move across these strategies. The other thing that I've been thinking about doing, and of course I don't really want to get into all the management of it, which maybe I need to find a good manager.
Hey, we can help with that. We've got a great software package.
Yeah, but you'd need to modify a bit for this. So offices like this, I've seen locally a couple of guys putting in desks and turning them into sort of co-work areas. So you're almost like HMOing an office.
I know people that do that, and they've done it for 3 or 4 years and stopped doing it.
Because of the management?
Well, because it's just a constant wipe the board clean, get more people in. It's a job. So which is the management?
It's
so
intensive.
It does come down to that. And then what they've done now is they've found it's just better just to rent it out as a whole to a company. But I mean, you know, there's always something out there that we can use to add on as a plugin. Mark, what do you think about lots of people out there and training companies will teach people to cut their teeth on buy-to-lets rather than going straight in, you know, when they actually want to go into HMO or to serviced accommodation. And people say, well, actually, no, start with buy-to-let, cut your teeth in and move forward. So I've got my own opinion on that. What do you think?
I'm very much into graduating things. So, you know, I come from a place where lots of people would, you know, tell, I don't know, people starting out to go and do a massive building and, you know, development and all the rest of it. And it's just not the route I took. And also, I've seen a lot of people get into a lot of bother. So, I'm okay, fine. HMO is not a major thing. And of course, it does depend on the person. And, you know, they've got corporate experience, so they're really diligent. What do they like? But, you know, doing a single let or two, then moving into a HMO or a few or whatever.
What if they've only got a small pot of cash and they're doing single lets, so they can't get their money back out?
Well,
so
if they can't, then they're going to get stuck, aren't they?
Because I kind of think of it differently. Because I went straight into HMO, and what I say to people is, look, you know, you've got to start with the end in mind, reverse engineer the future rather than try and, you know, forward engineer the past, because we need to start with that end in mind. And if you want to get to HMOs, there are companies out there that will lend to people with no experience. If you can't, you only need 6 months, so you can bridge finance, get experience with bridge finance, and then move on to it. And then refinance your money back out, because lots of people that talk to us, they will say, look, I've only got a small pot of cash, I want to get it right, I can only really use it once if it's for a buy-to-let, or I can refinance it if it's HMO. So I kind of see it a little bit differently. And I know lots of people that we kind of push down that, not push, but guide down to that strategy, then can momentum invest. And they can recycle that cash. Going.
And I don't think that's necessarily a bad way to go about it. I think it is dependent on
the individual.
Them. You know, if you're talking to someone who's, I don't know, maybe they've been in a completely unrelated industry, healthcare or something like that, and you know, they come in and they're not particularly confident, and you know, I can just see it. You know, they're like, oh, I'm going to get the builder in, and I just think the builder's going to pull your pants down, and you know what I mean? And that's going to happen. Then they're going to pick the wrong area. They're going to put a tenant in that, you know, isn't going to pay the rent. All that. And I can just see it. If I spot someone like that, I'm like, you've got to play it safe on the early. Get a single let. Make your mistakes at a smaller scale. Just do one. Wait 6 months. See it all, you know, show its face. Then you'll know how not to pay the builder up front, you know, how much you should be paying.
Build that power team, build that team together.
And don't make all the mistakes over, you know, on a bigger scale. Whereas, you know, if someone comes in and, I don't know, maybe they've had a business for the last 20 years and they've been involved in this sort of, I don't know, commercial, hustle and tussles that can happen, and they're investing in their local area. They know the area well. I think that's quite different. Yeah. So I'll usually push them down different roads.
There's no one size fits all, is there?
No, and I certainly know they shouldn't be buying a 20,000 square foot building and converting it.
No. I mean, I like your analogy. You can't just pass your test and get straight into a Ferrari.
No.
You've got to be able to cut your teeth and learn how to drive then, haven't you? What do you think about this word that I get a lot, and certainly a lot of people that in my community, saturation?
It's what, of HMOs? Yeah, I hear it all the time. I've been hearing this for, how long have I been doing HMOs? Over 10 years. And Peterborough's saturated with HMOs. I hear that more than, probably once every 6 months. And then I just sort of look at them and go, oh, right, yeah, I heard that 6 months ago, and the year before, and the year before, and the year before. And the answer to that is, it goes in peaks and troughs. So you will get times where there are lots of HMO rooms available, and you need to put a bit more work in to get them let. A. B, the ones that are available and not let are usually the rubbish rooms that are not well dressed. Maybe they don't have an ensuite. The marketing's crap. The photos are crap. The manager isn't responding properly to viewing requests. If you fix all that, your room won't be empty, because there's always a load of shite rooms in every town. And if you make yours one of the best, it'll be full. So
absolutely.
I think it's totally fixable. I just hear it all the time.
I totally agree with that. To put a slightly different look on it for people that are watching, exactly agree with what you're saying. So most of the rooms that people talk about that are saturated, they're in that middle market, So in that Magnolia, wood chip, brown teak furniture, 1980s landlord, Rigsby type stuff that's still out there. And most of the market is still made up of that. Yeah. But if you come out of that middle area and then go to the top end, there is far less competition.
Way less of them. And you get disproportionately more rent. With a single let, if you have a really nice single let, it might rent for $750 in a sort of locality, whereas a rubbish one round here might be $700. Yeah. So you get another 50 quid. If you do a HMO room around here, a shite one, without an ensuite, it's probably $280, $300. If you do an absolutely superb one, it might even be the same size with an ensuite, you get $550.
Wow, that's a massive difference.
You're almost getting double.
Yeah.
So it's absolutely worth it. You're getting paid for it. You're putting yourself at less risk, because clearly you can go right up on all the fire spec and everything, rather than if you're in that middle or lower end, you're getting worse tenants. They're probably disconnecting the bloody smoke alarms and all that stuff that puts you at risk. You can spend less on it to bring it up to standard. And you're making less money. Why the hell do you want to be there?
It's quite funny, isn't it? Because you mentioned that people that say, look, we get voids, right? We do get voids. That's part and parcel of, we're really, I don't want to sort of tempt fate, touch wood. We're doing all right at the moment. We've probably got 4 voids in the whole of our portfolio, which is all right. We're below that 10%. Yeah. But when people start posting, I've been void for 2 months, I've got so many voids, what can I do, what can I do? Yeah. What I will do is say, well, look, we'll see how we can help you here. Yeah. Can you post a link to your advert? Yeah. And then when you look at the advert, it's just very apparent why they're void, because they are in that middle market, the marketing's not so good. Yeah. And what we do is we try and sell the lifestyle rather than the house. Yeah. And we feel that, most tenants are looking for that better lifestyle. And it's not really just about the property. Yeah. So we talk about the surrounding area and all of the amenities that the surrounding area offers and how it can enhance their current lifestyle and why they should choose our house over everybody else's.
And create a community in the house with the other people. Maybe they do things together, or you get them organised. And once they feel like they've got a nice community and a nice room, they don't want to leave. They want to stay.
And that's the idea, isn't it? And they're our tenants are customers, aren't they?
Of course.
We've got to look after them.
You have. So are we starting to get some questions?
Are we getting any questions? Let's have a look. I don't know. Let's have a look at mine.
And Kieran, how about you? Do you want to have a look at yours? Yeah.
So Kieran, do you want to start? I've got loads.
Yeah.
Folks, if you've got any questions for Mark or myself, now is the time to fire away, over, and we'll do our best to get round to them. We are running several live feeds here, so we are going to try and dip from one to another. So, Kieran.
Okay, so I'll get started. So Susie Edwards. It's hard to find a buy-to-let that gives a reasonable cash flow. I'm increasing viewings and offers to make this happen, and I really do think a good standard buy-to-let deal will only be available to a cash buyer unless you do a no money down strategy.
Okay, that's a very generic question.
Yeah.
I think, like anything we
yeah.
do, Susie, it's all about consistency. And the more no's you get will drive you towards the more yeses. So what we say to people that are going through this, and it's the same with HMOs, you can't find deals. So this is essentially about deal sourcing. You can't find the right deals, you can't make them work. So what I'm going to say to you is that probably you're not doing enough viewings and not offering on every single property. So if you view 10 properties a week and you offer on 10 properties a week at a price that works for your strategy, then the law of averages is that you will get some of those deals over the line.
You've got to fill your pipeline up.
Absolutely. So it's about bringing those leads in, keep bringing them in. It's a numbers game. And then when you're negotiating with the vendor, you might start maybe doing some practice negotiations, maybe in front of a camera, maybe in front of a mirror or a partner, and start to think about all of the no's that you're getting now and the reasons. And what we do is we go for the no, because a no is an objection which we can work on, because it means that they're not happy about something. It might mean they're confused. It might mean they don't understand, which is kind of the same thing. They're not happy with the deal, or they've got somebody else influencing them to tell them not to do it. So it's all of that, really. So my best advice would be keep filling the pipeline and offer on every property, but make sure you offer at a price that works for you.
Perfect. Second one. This is from Paul. What does Brexit mean for my property investing business, and how should we be reacting over the next coming months and years?
I think we answered that one earlier on, didn't we? We went into a good bit of detail on that.
Yeah, and I think, you can't control what we don't know is going to happen.
No.
So what I was going to say to you at the moment, was it Paul?
Yes.
Don't do anything.
Yeah.
Sit tight. Let's see what happens on the 31st of October.
Another extension till March.
It will be, won't it? Yeah.
Well,
yeah.
Okay, this is from Laura. Should you manage your own property portfolio yourself, or should I outsource to a letting agency?
Well, that very much depends on how much time you've got and sort of where you are in your life. Are you working? I'm not really one for managing properties. Certainly with single lets, there are a lot of single let managers, letting agencies in every town, and I think it's a good use of time to outsource it. But there are lots of pretty inferior, pretty rubbish letting agents as well. So you want to test, put it with three, or put 3 different properties with 3 different agents and find the best one. With HMOs, it's not so easy. I'd say in this town, there's really us and another true HMO sort of letting agency. Lots of others will say they'll do them, but they won't clean the communal areas. They haven't got the right sort of tenants going in. And it can be quite difficult to find a manager for HMO. So you often end up doing those yourself just because they're not available.
I agree. And you know what? I've got to say this. I've got a property platform that I developed called Go Tenant, which is designed for HMOs and single lets. So you can leverage your time through it and actually do it yourself. You don't have to pay somebody else to do it for you.
Amazing. Okay, so this one's from David. How can I minimise risk when investing in property in the current climate?
So how can you minimise risk? Well, okay, what type of risk? You might have sort of, risk of property dropping in value or capital risk. I think if you bid very hard, fill your pipeline up, make loads of offers and buy very cheap, that is the best way to control the risk, because you're always going to be able to get out of it for the same or more money than you paid for it. I think you want to manage your contractor risk. You need to get good recommendations from other people for good contractors. Don't pay money up front for goods and materials because you end up getting stung, as I have been in the past and presently. You need to make sure, I think you want to manage your sort of finance risk, maybe more fixed rates. Maybe, make sure that you're not all with 1 or 2 banks, because clearly when things go wrong, then they try and get the money back, and you don't want to be exposed on that front. I think tenant, risk from tenants, you need to reference the hell out of them, and only put ones in. Have it void rather than putting a bad tenant in, because they will ruin the place, and you'll have to refurbish it, and you won't get the rent. It will take you months and months of court fees and all the rest of it. So I think you can reduce your risk a lot by tenant referencing effectively and thoroughly. Yeah, any other risks you can
I think
of?
all of that, especially tenants, because, folks, you go into this and you put your heart and soul into it, and if it's your first project, you put all your cash in it, and you're working with your partner or your spouse, and everything's great, and you're working towards a dream, and you get to the point where you've got your property ready, and then somebody comes along and promises the earth with a big wad of cash, and you rent it to them, and they can take that dream away overnight, and it can destroy everything that you'll ever want to do again with property. So yes to all of the above that Mark said, but absolutely reference those tenants. And if you're just simply not sure, don't take them. Simple as that, just don't take them. You don't have to, you're not obliged to, and don't be motivated by people that come to you and say, I've got 3 months in advance, I want to move in today, let's do a deal. Because you've got to make sure you get the right tenants. Do you know what? We've got tenants, Mark, in some of our properties. They've been with us 17 years, and we don't hear from them at all. Nothing. 17 years, they pay every month. I think they're still there. Well, they're paying anyway. So
what could be better? If you pick a really good letting agency, then they will reference tenants for you.
Yeah.
But what do you use to reference your tenants?
Well, we do everything in house.
Yeah.
So
what service do you use?
So first of all, I use Go Tenant.
Yeah.
So
okay.
I mean, I don't want this to be a massive plug for Go Tenant, but we use Go Tenant, which automatically asks the prospect about 10 pre-qualifying questions before the viewing.
Yes.
So we flip it, all of the due diligence we do at the beginning. And then we start to do the due diligence before we get to the viewing. If we're happy, then we'll get to the viewing. The viewing will go ahead. And then what we do is Go Tenant will send an automatic reference request to their current employer and their past landlord. Does it all automatically. And then we'll credit score. Now we credit score using Letting Ref. It's $9.99 plus VAT. And that will give you an affordability. It will give you previous address history and any defaults.
Okay.
And
do
then
they need to authorise that, or can you just
so it's authorised on the application form. So they have to tick a box for GDPR to say that they agree for us to conduct all of the checks necessary in order for them to get a tenancy. And then, folks, get onto Google and just Google your tenant, because, wow, you'll be really surprised on what you find on your tenant on Google, or not, as the case may be. Name, address, current address, date of birth, area, and just hit search. And if they've got a criminal record that has been given to them since Google's been in existence, then it'll be on there. And they probably won't have declared it, because we can't CRB check our tenants. It's not practical.
No,
but we follow all of that.
And when you do, it comes back and it's only non-spent convictions and and it doesn't go very far back. It's just not effective.
Google's awesome for that. And Facebook, most Facebook accounts are open. They're not private. So you can go on Facebook, search them, look at what their photos are. All of that. It takes a little bit more time, but Mark said, I'd rather have an empty room than a non-paying tenant. We've got 0 voids in our portfolio. Sorry, not voids, arrears. We have got voids. We've got 4 voids, but we've got no arrears at all because of the systems that we put in place, to counteract that.
Okay. Nathan has asked, do you have any tips on how to negotiate on a property price and close a deal?
Loads of tips on that. It's like a whole day. Mark?
Yeah, so, you've got to, in some way, try and give them what they want. So clearly you want a lower price, but what I try and do is give them everything else they want. So what time frame do they want it over? Do they want, some of the money now, exchange? Do they want to delay the completion because, maybe they don't want to move out, until later on? Is there some other way of cutting the deal so that, maybe they want to rent a property? Often I've even refurbished places and rented cheap to tenants if they can't afford much rent in exchange for me buying their house very cheaply. I'd often give them an offer. I'd be very nice about it. I'd then follow up. Usually, if I think it's just too much money, I'll put it on my list. I've got a sort of spreadsheet, and I'll keep sort of going back. I don't know, maybe every month, something like that, and just as I can see they're not getting any bites in the market, then I'll just keep sort of peckering away. Maybe I'll just send them a little email. Maybe I'll send them a few tips on trying to sort of sell it, whatever. But I think most of it is just keeping them there in your funnel and keep following up on them. The stuff that's been for sale for 6, 9, 12 months, sometimes I've got stuff after 2 years after originally bidding on it. They are often the best deals that I've done because I've stayed on them.
Yes, but I mean, I can't really add much to that. At the end of the day, folks, we're all people. People buy from people, and it's about building that relationship. And if that person's got a property on the market, and if you've contacted them directly and there's no agent involved, the likelihood is that you're not probably the only person they're going to be dealing with. So you've got to make yourself better than everybody else. So, by empowering them, by asking the right questions, by building up that rapport and that relationship is probably really, really key in that.
Okay, perfect. Next question. This is from Sharon. Is the property market in the north set to outstrip London over the coming years?
In terms of what?
Yeah.
In terms of price, then no, obviously not, clearly. In terms of yield, well, certainly at the moment, property in the north is, as I said earlier, going for asking price, but the entry level is still very low, so your yield is still going to be really high.
The yield is guaranteed to be higher, and the income is pretty much guaranteed as long as you get, buy in the right area and get the right tenant in. That's going to happen. In terms of the capital value and the price of the property, well, it's an unknown and it's extremely hard to predict. And I see all these predictions all the time, but they are the vast majority of the time wrong. You may get higher capital growth for the next few years in the north just because it's playing catch up. London's been falling, or whatever. But if you took a 20 or 30 year time horizon, then it's likely to be higher in the south, or has been historically. And I think after Brexit, people will start coming back in. You see a lot more of the foreigners. Currency is so weak. Sterling is extremely weak. It's the weakest it's been in my lifetime, since I've been conscious. So, once a lot of this uncertainty lifts, there is all this money on the sidelines waiting to come back in. Clearly, sterling is very cheap. Property looks cheap for a lot of foreigners around the world. And I think when there's certainty, this money will come straight back in. And the first place it's going to go is London, just because, that's what they all know.
Absolutely.
The Chinese, the people from the Middle East, Asia, they know London. They want to be in London. They've seen it on TV. They see it in the movies. You talk to them about Hartlepool. It's going to take a while for them to get used to that.
And if you were around earlier and Mark and I were chatting, Scotland right now is outstripping everywhere. So Scotland's gone up year on year by about 8%, and there's nowhere else that's gone up that far. So
off a low base.
Have a look over in Scotland. Who knows?
Yeah, off a low base because it hasn't risen much in the preceding years. Capital growth or capital price changes are extremely impossible to predict, actually, accurately, as are interest rates, as is GDP growth. You can probably go a year out, maybe, something like that, maybe a little bit more, but any more than that, I think you're just guessing.
It's opinion based, isn't it?
Yeah.
Lots of it is. Yeah.
Okay, so we have a lot of questions surrounding Brexit. This is from Diane. Is it smart to buy a property with the loom of Brexit?
All of these people must have missed the earlier talk that Mark and I had.
Just rewind. It's there. All the Brexit chit chats there.
We had like 20 minutes on this earlier. Go back and have a little look at it.
Okay, let's get to the next one.
Can I take one from my group?
Yeah, of course.
Is that right?
Yeah.
Okay, so let's just choose one from here. Hi, folks. Okay, so lots of people saying they're watching. Hi, Rick and Mark. Hello, chaps. Hello, everybody. Hi, Steve. So Steve's asking, so how can we go into a crash due to leaving the EU when we are in control of it and are aware of it? The last crash, it was the banks which overlent who were not in control. It's interesting.
Sounds like a Brexiteer.
A Brexiteer.
Yeah.
Are we in control of anything right now? I don't know. I mean, I think
the last crash wasn't necessarily just the banks that overlent. What happened was the wholesale markets closed down internationally. The banks couldn't therefore access capital. Therefore, they reduced the amount of lending that they were doing. Did they? Were the sort of huge impairments wholesale? Okay, RBS, had quite a lot. I'm not sure Lloyd's did. It was more just sort of HBOS, RBS, and a couple of others. But what happened was, it was the straw that broke the camel's back. All of these other sort of areas, industries, within the economy, had all gone too far. There there was excesses, there was prices, capital price rises, the
110% mortgages.
All this other stuff was going on, and that just precipitated, the drop in asset values that needed to come anyway. So I wouldn't say it was just the banks over lending. And if we sort of transpose that onto the situation now, you say sort of we're in control of everything, but I'm not sure. Maybe that's what Boris says, but I'm not sure Boris always tells the truth. Clearly, if and what is a no deal, but if, let's say, WTO terms are imposed, there are some big tariffs imposed on exports, which is conceivable. I don't know, 10-20%, maybe a little bit more on certain items, and exports reduce. That's going to put a shock back through into manufacturing, especially maybe into the service industry as well, which means that companies' purchasing managers' index is likely to go down. Companies are less likely to invest, less likely to spend, maybe lay people off, and that creates a shock in the economy, which pushes GDP down. So I don't think the government is in control of everything, unless, well, I suppose they can go and rehash Theresa May's deal, but are they going to get the Commons to vote for that? I don't think there's any control, is there? I
agree with all of that. All of it. I think it's a great answer. I don't think I can add anything to that at all. Hi, Andy. Andy's saying, first company to develop the digital camera in the world, Kodak. They had the golden egg and they didn't do anything with it. Yeah, thank you, Andy. Someone's asking for investment. Sorry, guys, this isn't for that. We're not here to lend you money, but good thinking outside the box. Paul, what is the best way of finding service accommodation demand apart from Airbnb? What is the best way of finding do you do service accommodation?
Yeah, so booking.com, you can start advertising, can't you? You can see the sort of level of incoming demand. You could also go and wind up some existing hosts. You could ring them up and you could find out when their accommodation is available. You'll probably piss them off a little bit, but if you want to build a business and you want to grow your serviced accommodation stock and know where the demand really is there in that area, it's probably a cheap way to do it.
Yeah, very much so. Check out some local hotels, see what they're charging, make sure you do it better. And like Mark said, go into booking.com, see what everybody else is charging, charge a bit more just to see if you can test that market. That's what we do.
And see how full all the others are.
Yeah, absolutely.
By ringing them up and checking online.
Okay, one more from this group then. Hi Mark, hi Rick, hi guys, how are you? Okay, Amit, hello Amit, hi both. What asset classes are you investing in now, and how much lower are you offering to cover perceived risk of a downturn? What asset classes are you investing in now, and how much lower are you offering? So we kind of talked about this right at the very beginning of the live feed. We were talking about commercial, we were talking about residential. For me, I'm still residential all the way. Mark is doing some bigger projects and some potential commercial to residential projects.
Yeah, so I've got a few sort of conversion projects on the go, retail on the ground floor, apartments, and sort of residential above. How much less am I bidding? Well, there isn't a sort of specific amount, but yeah, I probably factored in a 10% drop on the back end. I'm not selling units, I'm renting them, it's more long term. Am I going to get all my money out? Well, maybe if they drop, no. But we tend to take the rent. Asset classes, would I carry on investing in that? Yeah, I think residential is great. We were talking earlier on though, how much is enough? And once you've got a certain sort of, rump of it, do you then diversify a bit and just sort of hedge a little bit? After I've developed our sort of current pipeline, I suspect we may be doing more. I don't know, I may end up buying land and building commercial on it. I may end up buying more commercial buildings, maybe not retail, but clearly the sort of shared warehouse thing has become very hot the last few years, so that sort of puts me off a bit because I like the unloved thing, so I should be going down retail road constantly, but I do think that is there's a long-term issue with Amazon. There's a slow motion crash, so I probably wouldn't go too
It's
heavy.
not just Amazon now, though, is it? I mean, Argos are doing same-day delivery now.
Oh, I didn't
If you live
know
within a certain area, they're doing 2-hour delivery.
Are they?
Uh-huh.
Oh, well, that's good, isn't it? I like the sound of that.
It doesn't incentivise you to get out of bed, does it?
No. So, I'd probably do more of that. Clearly, we spoke earlier on about the co-work thing.
Yeah.
I think if you can create a nice environment for people to come in with the desks and work, and they've got coffee, and they've got meeting rooms, and they've got all this other stuff, I think that model is good.
I think in a busy city, it would work really well.
You've just got to have the right, it's a business. You've got to have the right model, you've got to be the right marketing, you've got to attract the right people. Other asset classes, clearly, we haven't bought loads of classic cars, but Rob and I bought a Testarossa last year. I think they've come off a bit. I think classic cars, most of them are falling. I did an interview with a classic car sort of dealer a few weeks ago. Obviously, they would sort of quite like to say, oh, it's certain things that are going down, but I think the whole lot's taken a bit of a hit. Watches. They're pretty pumped up at the moment. You like your watches,
about watches,
they've gone up a lot.
I don't know. I think
it's
going to come down. It's going to come down. So if you're in the watch market, it's very different because it's lower level. Yeah, you can make good money on it, but are you going to make as much money as doing a development or renting out a property long term?
Can't borrow money against it.
Absolutely. So watches, okay. So if you're in the high end of the watch market at the moment, talk about Rolex. Rolex market at the moment on some watches are seeing double value second hand. So I could go into my I've gone into my authorised dealer and bought a particular brand of watch, let's say for example a GMT Master 2, which is called a Batman, or one of them is called a Batman. I would pay £7,500 for that. The minute I walk out that shop, I could sell it for £17,000 on the second-hand market. Now, that's still right. You can do that right now. You've got to obviously get onto an authorised dealer list. And if they think you're selling watches, you're not going to get on that list anyway. But whilst there is money in watches, over time and growth, it's not going to go up way anywhere near property. Yeah.
I'd agree with that. And you can't borrow money against it, so therefore your return on capital is way lower. But it's fun, and it can be a good way to invest.
It's fun, and you get to wear them as well, folks. You get to, I enjoy my watches. I wear them. I haven't bought them just to baby and to put away and to nurture. It's something Mark's going. You've got a nice Rolex on as well, so great if you want to just wear something nice, knowing it's going to go up in value over time.
But clearly, what Rick is talking about is, he's very clever about what he buys. So it's very specific. Actually, what I almost all the time hear him talking about are Rolexes. They're Rolex sports watches, and he's just mentioned the Batman, and there's a Pepsi, and maybe a GMT, maybe a Submariner anniversary, maybe a Rolex Daytona. That is steel. These are very specific models within the Rolex range.
That you just cannot get.
You can't get at the limited supply. If you just go and buy any Rolex, it's probably not going to go up, it's probably going to go down.
Yeah.
So, and if you buy the vast majority of other watch brands, they will go down.
Yeah, absolutely, great advice. So, turned it into a little bit of a watch for them there. So, thank you, folks. I'm going to go back over to your group.
Awesome. So, we'll take a couple more from our community. This is from Rachel. Are your properties only UK based or further afield too? And if the latter, which countries do you think are good investments?
So I have invested abroad. I've invested in Eastern Europe, in Florida, various places around the world, nearly got involved in Spain. In every case, I regretted it. I realised how little, with hindsight, I knew about the market. Could you make money in those markets? Is property investment viable in those markets? Absolutely. But for local people who know what they're doing, who are on the ground, do I invest?
Knowing the laws, knowing the people.
The finance, the legal. Every time you go to another country, there's a whole different legal backdrop, and you've got to relearn it all. Yeah. So now, do I invest abroad? No. Do I like going on holiday and renting places? Absolutely. I think it's a great way to do it. I don't have any of the maintenance or a lot of the hassle.
And you can walk away from it.
Yeah, and actually it's not just me. I can hear.
I've got loads of case studies on people that have invested abroad. I've got some guys that invested in Jamaica. Yeah. I know people that have invested in Spain. I've got people I know that invested, of course, in Bulgaria.
I did
Mark has just hit the nail on the head, folks. Go for the path of least resistance. And if you've got an appetite of losing money, then go and invest abroad all day long. The case studies that I just gave you, one particular one who is a lawyer in this country, she got involved in a scheme in Spain, which resulted in actually she didn't own the land legally, and she started and instructed builders. They built the property. She found out she didn't own the land because she didn't understand the local legislation. They instructed her to take it down, and they sued her £80,000 on top as well. So she lost a lot of money.
You just wouldn't get into that situation in this country because it would be too obvious that, whereas would a Spanish person get into that situation in Spain? Well, okay, maybe the odd one, but the vast majority would intuitively know that they need to go and see that solicitor or that notary or whatever just to confirm that, the thing's right and they own the land. But we don't know that as foreigners because it's a different system.
I'm not saying that you can't get good deals abroad, because you can, because I do, there's always a yin and a yang. There's always somebody that's done it well. But just do what you know, because otherwise, but on the flip side, I was approached about 9 months ago from a TV production company asking if I wanted to go to Italy to buy a house literally for £1 and refurbish it because they're doing like a regeneration project in this village where they've missed the generation gap because all of the kids have gone off and moved away, and then it's just rendered this village derelict. So they did a generation project, and they've invited people over to spend 6 months there with a camera crew. And I turned it down for all of the above reasons. So even though I might get the house for free,
how much you got to spend on it?
There's still like an £80,000 spend, and there's still probably a load of risk involved. That you could lose all of that money.
And then what have you got at the end? The whole reason why they're wanting you or trying to get you to go over in there and spend that money is because what's the thing going to be worth afterwards? And who's going to want to live there? And the Italian government probably need to create some bloody employment out there and, in those areas, and then people would move back. That's surely the issue. Yep. In a lot of these Spanish, Southern Europe, they have dissipated to the big cities because there's no employment, there's no money.
There's nothing there.
No
so
activity.
I think, the moral of this is stay local.
Cool. We have a whole load of Brexit questions, but I'll bypass them so they can rewind and go to the start. So this will be the last one from our community. What is the biggest mistake you've made when purchasing a commercial property?
Biggest mistake I've made when buying a commercial property? I
don't do commercial per se. I can tell you
property?
My biggest mistake I made with commercial property is not selling it at the right price. So we were offered, I had a chain of pubs, I had like 6 pubs at one point, and we got bought out by a very large retail company. And we were offered £800,000 for one of our units. And at the time, I felt it was worth more because I was very naive. And of course, what I thought it was worth wasn't particularly reality. So they walked away, and they would have bought this. They were a massive company. They bought one off us, and they would have bought the second. So I said no. And then, of course, market shifts, things change. We hit the housing market dip, which had a bounce back effect on everything. And I still own that pub, and I've just put it back on the market, and I will accept £400,000 for it. So that's almost £500,000 less than I could have got 8 years ago. That's probably one of my biggest foolish mistakes. Sometimes you've got to think what is best. What are you trying to achieve? And I wouldn't have got any more than £800,000 for that property. And that's a commercial building, but that's kind of my big woe story.
I don't know. I mean, I bought commercial buildings and I've sort of tested the market and tried to let them, but I've always known that I've really wanted to convert them into residential, so it was no big deal, and then I've converted them. Some of my projects have taken a long time, sort of maybe 2 or 3 years, which is not great, but I don't know, it doesn't, create... I've always got challenges, loads of extra asbestos, getting asbestos out. The bill, on one of them, I think I was expecting it was going to be, I don't know, $250, and we've ended up spending, I don't know, $354. Someone came in and completely took the piss and said it's going to be $450 to get all the asbestos out, but that was for a commercial building, for a development. Assuming, when we're putting stuff on the top of a commercial building, assuming that the original building regs drawings from decades ago are as the building was built. In most cases they're not, because they value engineer it afterwards, so the steels they put in are inferior. It hasn't cost us a load of money, but it's been touch and go, and it's been sort of concerning to me, are the piles right, all this sort of thing. You learn that afterwards. I did buy a commercial building, and I thought I could put 2 floors on. Reality is I've got to put a load of extra steel in, to do that. So we'll end up putting 1 extra floor in. And the planners, I thought, it was just what they were bothered about was the cathedral, but actually they're also bothered about this clock on the top of the town hall. So you sort of learn stuff about that. But that's more of a planning issue. The commercial issues. Most issues with commercial centre around not being able to get a tenant in and having huge voids, and I see that quite a lot. It's all about location and what the building is in the use class. If you're buying it relatively central, the use class is sort of amenable and there's demand for that, then usually you'll get it tenanted. I see people buying things on the outskirts in sort of inferior tertiary locations. They can't let it and they just end up with the empty property rates and a load of void. And that can be really, really costly. So don't do that.
I saw a press release a couple of days ago about talk about going up 2 floors on a detached house under permitted development now.
And commercial buildings.
Yeah,
but
so
as usual, the press report comes out, but where's the detail? It mentions something about affordable housing only, and I thought, well, I don't really want that. But there are lots of housing associations that probably do want that. So I don't know, I've probably got some buildings I could do that on. But
I was thinking, right, okay, straight away you're like, 2 floors, another 8 tenants.
Yeah, but then I think, what about the existing tenants? I've got to clear them all out. And what are they going to think about all these?
Hey, we've got some students that are going into properties at the moment, and they are, with building regs, ripping it out completely and adding another floor.
Are they?
Yeah. So they're going, obviously, into the roof space, but actually adding another floor. It's a great way of maximising your return on a small house.
The profit is all in the last few units.
Yeah.
On a development, because your sort of fixed costs are taken up in the initial, the first 70% of the units or whatever. So
yeah, absolutely.
Yeah. Fantastic. That's everything from our community.
Oh, awesome. Okay, so if we just take perhaps one more from ours, we have been on just over an hour, I think. So are we okay for one more, folks?
Yep.
Yeah. Oh, good. So. All right, Amit. Hi, Amit. Amit's saying, what is the best way to cover yourself of buying a property with tenants in situ? What do you mean, Amit? Well, cover yourself. So I'll give you some tips here. If you're buying tenants in situ, let's talk about, regardless of whether it's a HMO, there's some things that you need to be covered under certain regulations. So first of all, if you're choosing to keep the tenant, the first thing you need to do is issue a Section 48 notice to your tenants upon completion. And then 24 hours later, you automatically then become their landlord, all right? So you take over the responsibility of their current contract in whatever form it is. Before you do that, you need to make sure that if your tenant has any deposit, it's either paid back to the landlord, and then, the landlord pays it back to the tenant, and then the tenant then will transfer it to you, so you can relodge it. Or if you're in the same scheme, you might be able to transfer it, and then serve them with the prescribed information again. You then need to make sure that you serve them with all of the other documents that cover you under Section 21 if you need to evict them. So you need then to serve them with the gas safety certificate, the EPC, and the government how to rent handbook. Get them to sign for it, and then you're good to go. And of course, make sure the rent is transferred to your account and not to the previous landlords, because sometimes that happens.
Well, what I'd say also is get a schedule of the payments that they've been making to see if they've been paying on time and to make sure there aren't any arrears, because that's probably going to be your best evidence as to the quality of them. Clearly, you could reference them as well. That would be a good idea, but payment history is probably the most important thing, because you don't want to be inheriting a rubbish tenant. Lots of landlords may like to sell their property onto you with that sort of tenant in situ, but you really need to get to the bottom with bank statements from the landlord of how the sort of performance of those of that tenant in terms of their paying their rent.
Yeah, very much so. And make sure they're not on a protected tenancy, which is probably the first thing you should do. So I'll rewind a little bit. So if they were on a pre-Housing Act tenancy, you probably won't be able to evict them. And then when they die, the right goes to their next of kin as well. So just make sure that there's not many people that are around now with protected tenancies, but just take that into account. I think that's it. Awesome.
So we are done. Thank you for watching,
Thank you,
everybody.
folks. Yeah.
Rick, thank you for coming
Thank
over.
you, Mark. It's been absolutely awesome. No problem at all.
It's been a pleasure.
Hope that's been useful to your community. And folks, thank you for watching. Keep the thread going. And if you've got any more questions for us, then tag us in below. Thank you. Have a great day.
There's been Mark Homer and Rick Gannon over and out.
Cheers.